Welcome back to Invest Avenue. Today, we're going to delve into the nuances of value investing, a strategy that goes beyond just looking for cheap stocks. If you're serious about investing, understanding value investing at a deeper level can help you capitalize on market inefficiencies with more precision and success. At its core, value investing is based on the principle that the market doesn't always price securities correctly in the short term. This inefficiency creates opportunities for discerning investors to buy quality assets at a discount to their intrinsic value. However, advanced value investors know that identifying undervalued companies isn't as simple as checking P/E ratios or price-to-book multiples. The real challenge is accurately determining a company's intrinsic value, which requires a comprehensive understanding of its business model, competitive advantages, growth potential, and the broader economic landscape. One of the more advanced aspects of value investing is conducting a detailed fundamental analysis. Beyond basic financial metrics, you need to assess a company's competitive moats, whether it's cost advantages, network effects, or intangible assets like brand value. For example, Warren Buffett's strategy focuses heavily on companies with sustainable competitive advantages that allow them to generate consistent free cash flow and provide a higher return on capital over the long term. Identifying these moats requires not just financial acumen, but also a deep understanding of the company's industry and positioning within it. Another critical aspect of advanced value investing is managing risk through the margin of safety principle. Seasoned value investors don't just look for a stock that's undervalued, they want to ensure there's a significant gap between the stock's current price and their estimated intrinsic value. This margin of safety acts as a buffer against unforeseen risks, such as changes in market conditions or errors in analysis. In today's fast-paced markets, where sentiment often drives price swings, maintaining discipline in applying this principle is essential for long-term success. Advanced value investing also requires an understanding of cyclical versus secular trends. A mistake many intermediate investors make is confusing a temporary downturn in a company's industry for long-term value destruction. For instance, cyclically sensitive sectors like energy, industrials, or commodities can appear undervalued during economic downturns, but an advanced investor must evaluate whether the downturn is part of a normal cycle or reflects a permanent shift in the industry landscape. Then there's the importance of contrarian thinking. While value investors often benefit from going against the crowd, it's crucial to recognize the difference between true value opportunities and value traps. A stock might look cheap for good reasons, such as declining market share, poor management, or unsustainable debt levels. Advanced investors are skilled at distinguishing between temporary mispricing and fundamental issues that could erode long-term value. To avoid value traps, investors need to dive deep into a company's balance sheet, cash flow statements, and operational outlook, ensuring that the business has the capacity to recover or continue generating value over time. A sophisticated approach to value investing also involves considering macroeconomic factors. While traditional value investing focuses primarily on individual companies, in today's interconnected world, broader economic trends, such as inflation, interest rates, and geopolitical risks, can significantly impact the valuation of assets. For instance, in a low-interest rate environment, companies with stable cash flows and high debt may still thrive, while in a rising rate environment, the same company's valuation could deteriorate. Recognizing these external risks and incorporating them into your valuation models is key to refining your investment decisions. Lastly, patience and temperament remain critical in advanced value investing. Value investors are often buying stocks when others are selling. This can feel uncomfortable in the short term, but the ability to maintain conviction in your analysis, even when the market disagrees, is what separates successful investors from the rest. As markets become more volatile and driven by sentiment, having the discipline to hold through temporary dips or even add to your position when others panic is crucial. Legendary investors like Buffett and Munger have repeatedly emphasized the importance of temperament in investing, noting that the biggest challenge often isn't technical but psychological. In conclusion, value investing at an advanced level is much more than just buying cheap stocks. It's about finding high-quality businesses that are temporarily undervalued by the market, ensuring a sufficient margin of safety, and incorporating a thorough understanding of both micro and macro factors. The ultimate goal is to build a portfolio of durable companies that can weather economic downturns and generate consistent returns over time. Thanks for watching, and if you found this deep dive helpful, make sure to subscribe to Invest Avenue for more insights on advanced investment strategies. See you next time.